Welcome to the Lend Academy podcast, episode number 42. This is your host, Peter Renton, founder of Lend Academy. There are some people who say that what we're doing in the online lending industry is really not that different when it comes to, providing loans to consumers and small businesses. It's really not that different to what was done 10 or 20 years ago. Well, I think our guest today, refutes that whole idea. Kathryn Petralia is the head of operations and co-founder of Kabbage. That's Kabbage with a K. And they are one of the true innovators in this space. They are doing things completely differently. I think their underwriting model and a bank's underwriting model would look so incredibly different that it has almost nothing in common. Sure, they're looking at financial data, but that's just the start of what they're doing. Kathryn in this show talks about, social data and how Facebook data it has been very predictive for them, and talks about digging into some of the other data points like UPS data, things that I have never considered and never heard of before, and Kabbage are using this as standard inside their underwriting model. I find they're a fascinating company, and I think this was a really fascinating interview. Hope you enjoy the show. Welcome to the podcast, Kathryn.
Thank you.
Okay, so let's get started by giving the listeners a little bit of background about you and about yourself and what you did before you started Kabbage.
Sure thing. Well, I've been in the, technology and financial services arena for the last 17 years. This is technically, my seventh startup. I love technology startups, and I guess about 15 years ago, started blending that with financial services. I've everywhere from, more pure fintech startups like Revolution Money before we started Kabbage to, larger financial institutions and pure tech startups in the 90s.
Okay, so then let's just go down to, I know you had, did you start Kabbage with Rob? Was that the story? And what was the reason for starting the company?
Sure thing. Well, Rob, who's my co-founder and our CEO, had the idea. And the idea was spawned by a public API that eBay launched in 2007. And he was working with a different company that was using the data for something a little bit different, but he thought to himself, wow, that's really, really rich transaction level data. I bet you could use that to make an underwriting decision about a small seller's credit worthiness on eBay. And so he contacted me and told me about the idea, and I said, well, that's really cool. I love the idea. And our third co-founder, Mark Borland, joined us as well. So we started working on this concept in late 2008. I started raising money in 2009, and we spent the first 2 years basically building the technology and didn't start putting out funds in any meaningful way until May of 2011.
Okay, and when you started, that was basically online only. You were focused on eBay sellers completely, or Amazon, or who were you targeting right off the bat?
Off the bat, it was only eBay and PayPal. Now, that was when we went live to the public in May of 2011. By August, we were working with Amazon merchants, and then by September, we had Yahoo and Etsy, and we were integrated and are with some of the platforms that enable businesses to sell on multiple sites using multiple channels. And we operated in that environment for a couple of years, serving only online businesses.
Okay, so then you decided to move, from online business only, which obviously you have access through the APIs, the rich transactional data that you mentioned, into any kind of business. So, can you just talk us through that transition? What was that like, and how much did you have to really adjust everything internally to go beyond just online businesses?
Well, it was always our plan to move beyond online businesses. It just happened that that's where the data was most readily available. Frankly, our business couldn't have existed at all 10 years ago because the data wasn't there. And 5 years ago, we couldn't have access to the data that we use today to underwrite brick and mortar businesses. But luckily for us, we were sort of ahead of that curve and have been able to integrate new sources that come online. we were already collecting data for online businesses that we could have used for offline businesses. For example, information in their checking account, or their accounting platform, or their payment processing information, or even shipping data and social data. So all of that information we had, and what we did over time is we built a model that we were able to use to move offline. So we really didn't even have to add more data sources, but we simply had to expand the population to which we were marketing.
Right.
And so about 2 years ago, we began expanding that. 2 years ago, if you would have asked me what percentage of my customer base were online businesses, I would have said 95. Today, that number is more like 30. So 70% of my customers are traditional brick and mortar retailers.
Mm-hmm. Right.
Not just retail, I should say. And businesses in general. It includes service providers, and it includes retail, restaurants, you name the gamut, any industry where we're covering them.
Right. And so, what kind of loans do you make? Or, I mean, are these just lines of credit, or, these like merchant cash advance loans? Describe exactly what you're providing.
So our product is a little bit unique. We provide a line of credit to our customers. Every loan is actually amortized as an individual installment loan. They can have multiple concurrent loans up to the total line amount that we make available. The reason that we're able to provide a line of credit, where most are providing an installment loan, a single installment loan, is because we stay connected to the data. So we're not just getting access to the information at the point of origination. Every day, we're continuing to gather the data from the sources that our customers have given us access to, so that we have an ongoing picture of their business health. And that allows us to manage their lines appropriately. For the most part, 90% of the time, we're actually raising lines and lowering rates. Sometimes we're shutting off access for the folks, that are struggling. But in every case, we're working with those customers to get them in a better situation so that they can take advantage of the opportunities that they're being presented with.
Okay, so that is a little different. So you are like monitoring each of your customers. What is it, a daily, monthly, weekly basis?
Well, daily, we're collecting the data. I'm not changing people's key pricing terms on a daily basis,
sure,
because that's not a very good user experience.
Yeah.
We have certain triggers, that, for example, immediately restrict access to capital. And there are several triggers that create that. But on an ongoing basis, we're reviewing customer accounts and determining, I would say, more periodically in larger batches, how we want to handle accounts where we're seeing change in behavior over time.
Right. Okay. So you'll find out something, and is this just through, the financial data? Does someone have to share their bank account, their QuickBooks? Is it? I presume something is going to trigger a change where you cut someone off. That's got to be pretty substantial, trigger to make that change, right?
That's exactly right. So every customer it looks a little bit different. So we have some of our customers who are giving us access to 10 data sources, and some are giving us 2. On average, we're getting 5 from every customer. So the way we review those customer accounts is different depending on the information that we've collected.
Okay, that's interesting. I want to dig into that in a little bit, but before I do that, I want to just talk about something you have on your website, which you go to your homepage, and it says you can have $2,000 to $100,000 in your account by 2:51 p.m. is what it says on mine, because it's just obviously you're taking the actual time and adding 7 minutes to it. So can you talk a little bit about this 7 minutes thing and how you're able to do that and why you do it?
Well, at first glance, it comes up kind of kitschy, but we didn't make that number up. What happened is we started monitoring the amount of time that our customers are spending in the application. And it averages about 7 minutes. Actually, it's gone down. It's a little lower than that because we keep, sort of monkeying with our user experience to make it more seamless, I guess, and easier for our customers. So the 7 minutes is really how long it takes to get through the process, because most of the time is actually spent typing. Our customers come to the site, give us a little bit of information, then they authorize these third-party sources to share data with us. The decision is actually made instantly. And depending on how they choose to take delivery of the funds, they could actually have the funds in their account in 7 minutes. For customers who use PayPal or who give us access to their debit card details, we can actually push funds instantly to their account, which is really fantastic. Now, it's not because people are desperate for cash. It's not because, they have this dying need and their business is going to go out of business if they don't get the funds right away. It's really much more about peace of mind And it's about not investing a lot of time into a process when you're trying to run a business and knowing that you're going to get an answer and you're not going to be kept waiting.
Mm-hmm. Mm-hmm. So if you have a PayPal account, you can automatically give their PayPal account or a debit card, but obviously a bank account, which I imagine, a good chunk of your customers are going to want the funds in their bank account. What's the turnaround time on that?
Well, the debit card actually puts funds directly in their bank account. Just to be clear, it's the debit card that they have with their bank.
Okay.
We're using the debit networks to move funds instantly. Now, for ACH, it's usually next day. ACH, as you know, we have a rather antiquated payment network in the U.S.
Mm-hmm.
Theoretically, we are working on expediting that, but I am not holding my breath. So we're always looking for other ways to get our customers funds in a faster, safer way.
Right. So that's why you sort of go around ACH, and I can see. So as long as they've got a debit card associated with their bank account, boom, they can have their money in 7 minutes.
That's exactly right. And our customers love that process.
Yeah.
It's also a great way to validate identity because we're making sure, we're getting the information in their checking account. We're able to confirm that the debit card, those transactions match to the transactions in their account. And we're able to see the name on the debit card. And so it's a great way to continually confirm identity, although we really don't have much of a problem with fraud just because we're triangulating across so many data sources.
Right. Sounds like it, yes. So let's just dig into that for a little bit. I want to go back actually to the Lend conference in 2013 where you spoke on a panel, and I sat in on this session and I was amazed at how creative it seemed from my perspective. Anyway, the data sources that you use. I don't know whether you remember it, but I remember it distinctly. At the time, you talked about, like UPS box size was a data point that you use, and the spread of like zip codes, just taking UPS data. And so I guess that's kind of fun and sexy and that sort of thing. But so I want to dig into a little bit some of the sources that you use that you wouldn't call traditional. Like everyone's going to look at the financial information, but can you just give us some of the sources of information that, not necessarily traditional?
Sure thing. The UPS story is fun, and I talk about that a lot, and we've actually refined it even more. Since 2013 when we talked about it, we have a unique relationship with UPS, and so we're able to get access to information that most folks wouldn't have. UPS is interesting because they actually know the location of every small business on the planet.
Mm-hmm.
And it's not just for shippers. Imagine if you're receiving packages at a location, UPS knows how long you've been receiving packages there. And they can also see the quantity of packages that have been received over a period of time. So let's say you operate a nail salon and you're getting at first 3 boxes a week of a certain size and a certain weight. And then over time, you see that go up because they're ordering more supplies. Now, that's only one piece of it because obviously they're receiving shipments from other places, but it's great for confirming sort of the longevity of the business. And UPS is great and shipping is fun, but we actually have a new one now related to social data. We've been collecting social data for several years now. We actually launched that program, I think at Finovate maybe in 2011 or 12. Anyway, so our customers give us access to their Facebook and Twitter pages. And what we found, they're business pages, they're fan pages. What we found is that businesses that give us access to an active Facebook account, business account, are 20% less likely to be delinquent than those who don't.
Interesting.
And when we started that, we didn't know what we were going to find, and we didn't know why. What we've learned is that it's because it's a measure of reciprocal engagement. So our customers who are actively interacting with their customers are simply running better businesses. And we actually built a Facebook-only model that I can tell you about if you want.
Yeah, I was going to actually ask you about that in a follow-up question because I saw an article, I think it was just last week, where you made a statement that I thought was quite controversial or certainly something I hadn't heard before. And you said something like, I can just basically underwrite from Facebook data. That's all I need. And so can you explain, and I'm probably misquoting you precisely, but anyway, can you explain what you said and what you mean?
Sure thing. And what happened is we built a model using Facebook data that is as effective as using a FICO score for a small business loan. Its predictive power is equally as effective. Now, nobody would say, including FICO, that using a FICO score for a business owner is the only data you should use to make an underwriting decision about a small business. Having said that, we're pretty excited about the fact that the model we built using Facebook data is more predictive than just using a FICO score. And we do layer that in with other data. I'm not running a Facebook-only model today. It's unlikely that I will. Having said that, to qualify customers based on Facebook data, that's a really, really, really powerful tool. And again, it simply means that there's a lot of really rich data in how our customers interact with their customers. And because we're a commercial product, not consumer, and we're using a commercial application of Facebook, we don't have the same sort of FCRA risk that you would have with a consumer one.
Sure. No, that is fascinating. People have talked about the predictive power of social data, but no one until you said that, have I seen anybody saying definitively that it can be predictive. And obviously you wouldn't build a business around Facebook data and nothing else, but it's fascinating nonetheless. And so I want to ask, like, other social, you mentioned Twitter. What about Yelp for like a restaurant? Because one of the things you also said back in 2013 was, you don't care whether they've got a 4.5 star rating. It's more about the consistency of reviews. Is that something that you still are looking at, and have you refined that any further?
And yes, we have refined it further. And yes, it is very important that it's consistent. It's funny, when I travel, my husband and I use TripAdvisor a lot to find restaurants abroad. And we're always worried if there's a restaurant that only has 5 reviews, but it's got 5 stars, and it has 250, but it has 4.5 stars. So it's really, frankly, quite logical how you would approach the review data. But I will say the review data, again, it works a lot like this UPS data for somebody who receives packages. How long have they been receiving reviews? How has that, what's that trajectory been for volume and quality over time? And we found it to be really, really unbelievably predictive, whether it is Yelp or Foursquare or Facebook or Amazon or eBay. Review data is really quite powerful.
Yep. Okay, that makes sense. So, you've been going since 2011. I mean, you've been growing pretty rapidly. Can you tell us? I mean, we're recording this right at the very end of June. I mean, can you tell us how the first 6 months have been this year compared to last year?
Oh, well, we're around 3 times bigger than we were last year. From the volume perspective, we're putting out almost 3 times as many loans as we did and 3 times as many dollars as we did last year. It's really been remarkable. A lot of that is due to our shift in business, but a lot of it is due to sort of the economies of scale and the brand recognition that you get with as you increase the number of impressions that you make in every customer's mind. And frankly, a lot of it is just getting much better at finding those customers. My co-founder, Rob, likes to say there are 1,000 shitty ways to find small business customers, and we have to be good at all of them. And it's true. It's very hard, but we've gotten really good at marketing and sales and business development in that area.
Right. So how do you find, how do you find customers? What are the main channels that you're using today? Well,
we have three channels. Marketing is the largest by quite a big margin, and that includes, search engine optimization and search engine marketing and display advertising and, all of the usual suspects, creating content and driving traffic. And so we've really nailed that. In our industry, what you find is a very strong reliance on referral deals with ISOs, independent service organizations that typically are selling credit card processing to small businesses, and they charge a very hefty fee in order to do that service. Anywhere from 8% to 15% is what a normal ISO will charge, or a broker, so to speak. So our broker network is less than 2% of our business, and we cap their fees at 4%. So we don't do a lot of broker business because, frankly, they can get more money from our competitors.
Right.
But we do have a sales team, and we didn't have a sales team a year ago. We've really built that up, and it's been a fantastic add to our growth because, again, you have to have a multi-pronged approach. About 20% of our volume this year is going to come from referral partners that our business development team is bringing in, and those are companies that are also serving the same population, like we just announced a deal with UPS recently, and they want to offer our product to their customers. And the reason they want to do that is because they recognize the flywheel effect of providing capital to their customers. They know that will help their customers grow and therefore buy more stuff from them.
Right. That makes sense. Okay, so I want to talk about the other side of your business, or the investor side. You've been a balance sheet lender from day one. Is this something that you're you're committed to staying true to that model, or are you going to take on like a marketplace type approach?
I would say we're very open-minded about that. We're a balance sheet lender today, and because we've been able to do it very efficiently. The operational leverage that we have from a fully automated product is really quite remarkable. I am probably 50% more efficient, if not more, than almost anybody in our space. And that is the case because 95% of our customers have a 100% automated experience. So I can have a direct business and take advantage of those margins, and I don't have to worry so much about the balance sheet risk, so to speak. By the same token, and we just increased our securitized warehouse to just over 900 million, I believe, dollars. So we're excited about that opportunity, and we can keep growing it. However, we're open to other options. For a consumer product, the carrot product, we actually take that off balance sheet, and we're selling this whole to investors.
Right. I do want to get to carrot in just a little bit, but before we go there, I also wanted to ask you about your app. So you have a standalone app, Kabbage, and I want to get some idea on the traction that's getting. Is this something, and just mobile in general? I mean, not everyone's going to use your app, but a lot of people are going to use your the mobile device to access a loan. So, what can you give me some idea of what sort of traffic is coming from mobile?
Yeah, roughly 25 to 30% of our traffic is coming from mobile. Now, that's not the app, and I don't know the actual breakdown there. But that means that folks who are accessing the site. So we have the mobile app, but frankly, our site is mobile optimized. It's responsive. So it's a very easy process, whether you're looking at it from on a phone or a tablet or a laptop. And more we're finding that people are accessing it with a phone or a tablet. And what's important about the mobile app is that it's a really quick way to get access to capital for an existing customer. So they can log in super quickly, see what they have available, take funds, have them in their bank account instantly, or in their PayPal account, and they can move on if they have an opportunity or they need funds instantly for some reason. So what you're going to see from us over the next 4 months is some additions to that integration that will allow customers to complete the entire application using a mobile device and leveraging the actual features of the mobile device to complete that application instantly. Whether it's scanning, documentation, or geolocation information, the idea is that somebody can actually complete their application in 2 minutes instead of 7, and all from a mobile device.
Yeah, so I could see how that would be very convenient for existing customers because it's 7 minutes is convenient, but 2 is even better. So that's great.
2 would be for a new customer. Yeah, exactly.
Right, exactly. So I want to talk about Carrot because you launched that last year, and you've gone now from small business loans to consumer loans. So why did you do that?
Well, there were 2 real reasons for it. The first one is that 30% of the customers who are coming to our site, that's 30%, sorry, I'm talking quickly, were actually consumers. Either they were true consumers or they were startups, entrepreneurs who didn't have enough business history for me to underwrite them as a business, but they still were looking for credit and they were willing to borrow personally. So we said, well, we should probably take advantage of this market. All of these customers that are coming to the site anyway. That was one reason. The other one was to demonstrate the power of the platform. We talk a lot about our platform today, and we've observed that a lot of people are sort of parroting that term platform. And platform is a really important thing for us because what it means is a system that is able to stand on its own 2 feet and can be used for something else, for someone else, for a different purpose, not just a replication of a bunch of processes somewhere else to achieve the same goal. So what we were able to do in 60 days is using the Kabbage platform, launch a consumer product off of the same skeleton, so to speak, really, really quickly. And we were really excited about the ability to do that.
So you didn't start from scratch then, creating a new underwriting model. I mean, obviously, if you're doing a consumer loan, you're looking at UPS data or Yelp data or that sort of thing. So there's a whole bunch of data that you had to just throw away, I imagine. But so how were you able to create a consumer underwriting model, so quickly?
I wouldn't say we threw away data because we're collecting different data for consumers. There are 2 things we're doing that are unique in the consumer lending space. One of those things is we are instantly verifying a customer's income by using their checking account data to confirm deposits and to confirm income. And that's important for 2 reasons. Number one, it's a risk mitigation function, so we can be sure that we're providing the right line the right amount to the right person. And secondly, from a regulatory perspective, the CFPB has been really focused on ability to repay with good reason. So we're able to confirm that we're not giving our customers more than we should. And I think that's something that's very different in the space. The other thing we're doing is we're actually instantly funding it. So that way our customers can get access to capital more quickly. Most consumer lenders who are in the space are actually not instant because they actually have to, number one, it's not automated. Renault from Lending Club was quoted an increase in saying that 30% of their customers had an automated experience, and many of those still had a manual fraud review. So it's not actually instant. And then they have to sell the loans in the back and place them, so to speak, with the appropriate investors. We don't have to do any of that. It's all very quick for the customer.
So again, how are you doing the 7-minute deals? I know you go to Carrot, and I like the branding you've done. You go to Carrot with a K, and you see a very similar feel to the website as Kabbage. But then, and there's a 7-minute thing as well. So
it's 3 minutes. Actually, for
is it 3? I stand corrected.
Well,
no, actually, it's
really what it is.
No, actually, it's on my computer, on my browser, it's 7 minutes. Get your loan offer and rate as soon as 3:10 p.m. and it's 3:03 p.m. at my time. So,
well, we're lying because we're doing it faster, but that's okay.
But anyway, regardless, so how is the consumer getting those funds? Because they don't have a PayPal account, or is it debit card? Is that the primary reason?
That's ACH. We will have debit with the relaunch of our mobile application and our mobile responsive site. It will be debit card also for consumers, but today's ACH. So most of them are getting it the next day.
Oh, okay, I see. Now I read it. I read it more carefully, and it says get your loan offer and rate. It doesn't say get your money. You got me there for a second, because I just assumed it was the same as Kabbage. So anyway.
We're all sneaky marketers.
Yes.
So I don't think the intention there was to obfuscate the
the
delivery, but it's true. But I guess the risk manager in me says, I'm not sure I want a customer that needs the money instantly. So that makes me a little nervous. But by the same token, you want to be done with it. You don't want to be done with the transaction. You don't want to decide you're going to go to Bloomingdale's and buy a pair of shoes, but then they're like, yeah, you need to come back tomorrow and then sign the paper to get your shoes. You just want to be done with the transaction.
Yep. No, that's exactly what happens. So what are the loan terms that you're offering to borrowers today on Carrot?
Today we're only offering consumer and commercial loans. We just announced actually the Kabbage loan card. So our customers actually will be receiving plastic cards in the mail they can use to swipe at the point of sale and access their Kabbage funds immediately. And so we're very excited about that because it just creates, again, another level of utility for our borrowers.
That is interesting. So, and what about on the Carrot side? These are installment loans?
These are installment loans, and I think you'll see by the end of the year some innovative new products. I just said innovative, and you're making me sound like I'm British. The innovative new products that will be for consumers that, again, are directly tied to our permanent access to data to continually underwrite our customers.
Right. And you mentioned the whole loan program you have on Carrot. I know you're a part of the Orchard platform. So are you actively soliciting or trying to attract investors, or do you just have enough that you don't really need to market that side of your business?
I would say both. You always have to market it because we're new. It's a new product and it's untested, even though consumer lending, frankly, is really quite limited. The number of data points that you can use and how you can assess that data, and everybody's using credit report with a couple of other things. But I mean, your improvements are on the margin for the most part with consumer lending. So I think that the next 6 months will give us enough track record to dispense with the need to continually seek investors. We are having great luck on the Orchard platform as well as with folks who are frankly just coming to us to buy them. Right.
Yep. Fair enough. So are you using your balance sheet at all for Carrot, or is it all marketplace?
It's I guess you could call it marketplace. We're selling loans we're selling all the loans via the platform. It's not a balance sheet business.
Right. So, and how are you deciding? Is it a randomized kind of selection? If you've got a bunch of different investors, how are you deciding who gets what?
Well, it is tiered based on risk. Certain investors are seeking certain yield. So that's generally how we do it. And there are multiple investors in a particular tranche. then you're randomizing the delivery of accounts and receivables to those investors in that tranche.
Right. And so what are the interest? What is the range of interest rates you're charging on Carrot?
On the low end, I think we're 6%. On the high end, I think I'm 25. It might be 25.6.
Right. Okay. So then,
but our average is in the low teens.
Right. And do you have I know that you might cringe at this question, but do you have like an average FICO score? It's one way to compare platform to platform as far as the typical borrower.
Ours is probably higher because we are targeting a higher FICO population. I don't actually know the answer to that question. I should. I'm sorry, but
that's okay.
I can tell you that our cutoff is probably higher than other consumer lenders.
What is your cutoff?
Higher.
Is
that too evasive? I'm sorry. I don't know if I can say that.
That's okay.
To the general public?
Well, no, a lot of companies have it on their website, so I didn't realize that was something you didn't want to share, but no worries.
Well, the reason they have it, I honestly don't know if I can share it or not. It's funny. There are things I'm like, well, I'm not allowed to say that. That's fascinating. But I think it's because they're selling their receivables to the public, and so as a result, they have a lot of restrictions and requirements on disclosure that I don't have. Because I'm not selling to retail customers.
Yeah. Okay. So I want to let you go. Before I do, I wanted to find out what's next for Kabbage. You've kind of got this fun thing happening with vegetables. And, is cauliflower going to be next with a K? And you're going to go into student loans. I mean, what is next for Kabbage?
It really ought to be cauliflower. No, I mean cantaloupe.
Cantaloupe. Well, it's not a vegetable.
But I know, exactly. We should go into the fruit business. But what we're excited about next is actually this platform concept that I mentioned earlier. So we're launching this month in Australia with Kika Capital. Mm-hmm. They're actually, the parent company is the largest consumer lender in Australia. And we'll be launching in the fall in Europe, actually, with a large pan-European bank. And so we're very excited about that. And we have many other relationships in the pipeline with large banks that want to license and customize the platform so they can serve customers that are already their customers. Today, 80% of my small business customers bank with the top 10 banks. They're mainstream businesses, but the banks don't have the ability to provide them with working capital, not because they don't want to. They're not bad guys. They just don't have the technology to do that cost effectively. So our goal is to help those banks provide these products and services to their customers.
That's fascinating. That's great to hear. I think it certainly was one of the themes of Lend It a couple of months ago, and it's great to see some of those things coming to fruition because partnering with banks I think is it's a win-win for everybody I think, and I'm hoping that this industry does continue that sort of thing. So. Anyway, on that note, I very much appreciate you coming on the show, Kathryn. It was fun.
Thank you so much, Peter. This has been fantastic.
Okay. See you later.
Take care.
Bye. What is curious to me is that here we have a really a cutting-edge company, and they are doing things very differently, but partnering with traditional banks because, let's face it, businesses for at least for the foreseeable future are going to need a checking account. They're going to need to have some kind of formal banking relationship. And so there's thousands of banks and with these business relationships, but they're not leveraging the relationship, and it's a huge opportunity for this industry. And I know Kabbage are doing it. There are other online lenders that are also really looking to leverage those relationships the banks have with their checking account customers. It's a massive opportunity that I think will. If this industry is going to become successful and mainstream, those are the sort of relationships that will make it so. Anyway, on that note, I will sign off. Thank you so much for listening, and I will catch you next time. Bye.